96.7 FM WTOB. You're listening to The Wealth Guardians with Doug Ray, helping you to retire the job and keep the paycheck. I'm your host, Doug Ray, and with me is Brice Payne. Today, we're going to open up the mailbag and answer your questions. Stay tuned for the second segment. I'll give you a market update, and I reminded you a couple months ago about the canary in the coal mine. I think I found it. Good morning, Brice. How you doing?
Doug, I'm excited. The deck is almost done. You know, it's been months in the making. We're able to go out there and put our chairs out, and they're putting up the privacy wall now. And
it has been months.
It has been months, but you know, this was the right time of the year to do it. We're getting it done just in time for spring and summer, and I'm planning on hosting neighborhood games out there on the weekend, whether it's baseball or football and whatnot. And there's plenty of room out there on the deck for everyone in the cul-de-sac to come on over, and we're going to be proudly serving anything that anyone wants to bring.
Now, have you got a grill?
Yeah. Okay. So that's an interesting question. We do have a grill, and I just sold it. I am getting a outdoor griddle. Okay. I am horrible at grilling. I don't know what it is, but I can't do it, but I love to griddle. And so I'm buying, and I traded in the grill for a griddle, and yes, we've got a whole table area set up for that, so it's kind of a little cooking station out there.
Sounds like fun.
Very much so. So we're going to talk about listener questions here today, Doug. Before we do, of course, let's do our salute to our men and women in uniform out there, and of course your families as well. You are always in our minds. Doug here served in the Navy, as did his son Garrett, who is joining the Wealth Guardians right now, and he's sitting here in the studio with us. But Garrett, thank you for your service. Doug, thank you for your service, and everyone else out there, thank you for your service as well. We appreciate you. Mom, Uncle Scott, and my stepfather John, thank you for your service, and we appreciate you. And there's your Wealth Guardian salute for the week. So let's move into the questions here, Doug. We got a lot of good questions since the last time we did this, and we're going to start off with Mary in Walkertown. And Mary says, Doug and Brice, I'm 62, and I have about $1.4 million. How much can I spend yearly without running out? And I like the way that she worded this question. She told us how much she has, and instead of her saying, am I ready to retire, or some kind of more abstract question, she says, how much can I spend yearly without running out? So it's a simple reverse math question. We do this for our clients, even if they don't think to ask this question. When we're sitting down and doing a planning process, I know that that's one of the questions that a lot of people don't think to ask, is they tell us, well, I think I want to spend $3,000 a month. Well, if they can obviously end up spending a lot more than that, they probably want to know, how much can I spend, even though they might not have articulated that question. So we do that question, Mary, for all of our clients who come in here. And I'm just going to give you some insight, and Doug, you chime in here too. I'm going to give you some insight, Mary, into what other things I still need to consider when answering a question like that. You need to consider not just spending your $1.4 million, but you're going to have other sources of income coming in that are going to supplement your withdrawals from your account. So we have to understand what you've got coming in from Social Security. Maybe you've got a pension out there. Maybe you've got some passive income. A lot of our clients have rental income or some other form of passive income. Maybe they own a business that they're no longer running, but they still partake in the ownership of it and therefore some income from it. So that's the other income options we have to understand to answer your question. And then additionally, two things that we also need to consider is, what do you expect the inflation rate to be? Doug and I can tell you what we think it's going to be, or what we think is a reasonable expectation for a 20-year, 30-year average of inflation. But you have to tell us what you want that inflation rate to be. And then the last one that we would have to factor in here is, what kind of growth potential do you want to see or expect from your investments? Because that's growing. Inflation's growing as well. You're not just sitting there at $1.4 million in cash, obviously, and that's not the only source of your income, is that cash or that $1.4 million. So there's a lot of other things we have to consider, but the bottom line is that we do answer that question once we've collected the rest of that data, and it could be anywhere from, at $1.4 million, you're 62, you're going to have to fund your own Medicare for a while, but you could easily be looking at $7,000, $8,000 a month, something like that, with $1.4 million saved. Doug, I did all the talking there. What did I miss?
Yeah, you did. And you were very thorough with that. And I like the question because it's a very forward-looking question, and most people don't think about that really. And we do. We do that math for them. We show it to them in the fourth meeting. We give them a comparison graph to look at.
Third meeting, actually.
Yeah, true, third meeting. And, so it's a excellent question, Mary. It really is.
Yeah, but we'd be happy to answer that for you. You'd have to come in and we'd have to take a look at all those other factors and talk to you about what we think are reasonable assumptions to make and get you that answer. And if that means that you can retire now, or if you can spend as much as you'd like to in retirement, then, we'd love to help you get to that point. And if you do want to give us a call, it's 336-391-3409, and anybody can reach out to us and sit down with us whenever it fits your schedule. We're going to move on next to George in Kernersville, Doug. And George says, Doug and Brice, I have all of my retirement savings in one IRA. Should I move some of it somewhere else to be diversified?
I see them now. They're talking to you more than me.
I said Doug and Brice.
That's pretty good, though.
Yeah, they did leave out your name, but I threw it in there. I was courteous.
This one here,
Sure.
I would rather see somebody have just one IRA than several years ago somebody came to me, this was before you, 24 IRAs. Mm-hmm. Now, that's ridiculous.
Well, that's not too far from what my wife had before we got together.
George, actually, the thing is no. As long as the custodian has the ability for you to be diversified and have, not all your eggs in one basket, so to speak. The other thing I would tell you, one of the things that we do for our clients is have some kind of downside protection in those IRA accounts. I think this day and age, that is vitally important. But just having one or two IRAs, no, I'd rather see that than 8 or 9.
True, and I think there can be a little bit of confusion about what diversification actually means. It's not unusual that we'll see someone come into the office and they'll say, I use 3 different money managers because I want to diversify, or 3 different advisors because I want to diversify. That's not really the way that you want to diversify. Diversification generally means that you have your investments spread out over a broad range of sectors and companies and different types of investments, maybe some precious metals in there, some real estate in there, some alternative investments in there. That's the true meaning of diversification. You could have 2 different IRAs, each one managed by 2 different money managers, and 90% of the portfolio could be the same at both of those places. So that's not what we really are meaning when we say diversification, George, and that's not the way I would want you to think of it either. One thing that I think you're leaving out here, and Doug didn't mention that I think is key, is let's talk about diversification through the types of accounts that you have. So you've got an IRA right now, George. To diversify for tax mitigation purposes, I'd have you consider opening up a Roth if you don't already have one.
Great point.
And diversify as far as how your accounts are structured for tax purposes. That's, I think, more important than opening up 2 or 3 different IRAs and probably having some of the same holdings in each of them. If you're just joining us, you're listening to The Wealth Guardians, and this is Brice Payne, and we're dipping into our mailbag here for the first segment. We just talked to Mary in Walkerton and George in Kernersville, and we're going to move on to Billy in High Point now before the break. And Billy says, Doug and Brice, my parents lived in Germany for a while and had a home there that I inherited. I only travel there once every 2 years, but the house has sentimental value to me. At what point should the impracticality of keeping the home outweigh the sentiment? And Billy, I love that question. And
that's not one you get very often.
That is not, but it is something that I think, Doug, you and I see in a slightly different way frequently. And it's what he's really asking us, what Billy's really asking us here is, when do the cons outweigh the pros of having this property out there that he doesn't use that much?
Yeah, and it's in Germany too. He doesn't tell us. Does he rent it out?
Right. That was my first thought is, Billy, what kind of income might you be getting off of this?
Being a long distance landlord is tough. I've done that, but that was Charlotte to Fayetteville. This is from the Triad to Germany. That's a whole different kettle of questions.
It is, and I think, Billy, if I was to answer the question point blank, it would be, when does owning that property become detrimental to your retirement? When are you not able to do the things that you want to do just because you're investing a certain amount of money, or you're holding back potential investment income by simply sitting on this because you don't want to get rid of it? And that's really where it comes down to. And of course, Doug and I could help you figure that out, but that would require a planning process to go through. It's not something I could just answer here over the radio, but you are thinking along the right lines. And I'll tell you this, Billy, Doug and I do see this not so much in the way of real estate like you're talking about, but Doug, it's very common that we see somebody have an inherited IRA or some kind of inherited account, whether even if it's a non-qualified account, where they are refusing to sell the holdings that their parents might have bought and purchased, even though they're not sensible holdings for them anymore, because there's a sentimental value attached to them. And we see people make bad investment decisions because of sentimental reasons. Yeah. And we would encourage nobody to do that. We always want somebody to make the right decisions. But I would say one right decision that you could make out there is giving Doug and myself a call at 336-391-3409 and schedule a time to sit down with us and go over your retirement plans and see what services or goals or objectives we could help you define and better prepare your portfolio for that. Again, it's 336-391-3409. And Doug and I would look forward to sitting down with you, but you do got to give us a call. Doug, we've got to do the trivia question now.
Well, I was wondering where that trivia question was.
Let's see what we can do. It's time to stump Doug.
It's time for the Wealth Guardians Trivia Question of the Week.
Doug, on March 26, 2000, Vladimir Putin is elected president of Russia. What president preceded him?
I think I know the answer.
All right, we will get to that after this. This is Brice Payne. With me is Doug Ray. The show is the Wealth Guardians, helping you retire the job and keep the paycheck. And this is 96.7 FM WTOB. 96.7 FM WTOB. You're listening to the Wealth Guardians with Doug Ray, helping you retire the job and keep the paycheck. I'm Brice Payne along with Doug Ray. In this segment, we're talking about the market and what to expect and Doug's insights into it, as long as answering a few more listener questions. Before we get started on that and before we get back to the trivia question to see if we stump Doug this week, I want to ask everybody out there a quick question. Are you 5 to 7 years from retirement? Do you want to confirm that you're making the best decisions for your retirement? If you answered yes to both of those questions, then as I do every week, I've got great news for you. Doug and I and Garrett here offer a no-cost, no-obligation second review so you can learn how to retire the job and keep the paycheck. We are financial planners, we are fiduciaries, and we are retirement specialists. We meet with clients week after week, month in, month out, year in, year out, and we have helped thousands of clients in the Triad area and in the Charlotte area help people figure out how they can retire and do it successfully. But you've got to give us a call. And our phone number is 336-391-3409. That's 336-391-3409. You can also visit us at thewealthguardians.com. We'd love to hear from you. We'd look forward to sitting down with you and seeing what help and services we can provide in helping you retire the job, yet keep the paycheck. Now, it's time to get back to that trivia question and see how Doug does.
It's time to get Doug's best guess for the Wealth Guardians Trivia Question of the Week.
Doug, on March 26, 2000, Vladimir Putin is elected president of Russia. What president did he precede?
So the more I think about the way you...
Preceded him, sorry. What president preceded him?
The way you said that question, I think this is a trick question.
Oh.
Boris Yeltsin was the first president of Russia. Then it was Putin, but he was term limited. Mm-hmm. And then he put in a puppet called Medvedev. And then he took over from him, and he's been president ever since. So I think that happened in 2000, so I'm going to say Medved.
Well, yes and no. I'm going to give you that because you're right. The way I asked the question was a little vague. In March 26, 2000, Vladimir Putin became president for the first time. And you were right. Though the answer I was looking for was Boris Yeltsin. Okay. But you said that. Right. But you're right. He had, because of the constitutional limits, Putin was not able to keep being president. So he had Medvedev come in, who was his prime minister or something. Mm-hmm. And he sat in there for 4 years. And then they had restructured the constitution in the meantime. So Putin could come back in and be president now semi-permanently, apparently. But yes, it was Boris Yeltsin was who I was looking for. And before that, you know who was before Boris Yeltsin? How far back can you go?
That was Gorbachev, wasn't it?
Very good. Gorbachev, before Gorbachev?
Brzezinski?
No, Chernenko,
yeah.
And Dropov was in there for a year. And then It was Brezhnev, Khrushchev. Somebody that was only in there for a couple of months that history doesn't remember his name, Malenkov, and then it was Stalin and Lenin, going in reverse order.
I don't go that far back.
Okay, well, fair enough.
I do remember Gorbachev.
But you do go far back enough that we didn't stump Doug this week. He finally got that bell. It's been a few weeks since he got that bell.
I did fly against Gorbachev's Soviet submarines.
Oh, very good. I'd love to hear some more stories about that. We've heard the story about Garrett and having to work with your Tesla guy there, but I'd love to hear more of Doug's Russia stories as well. Doug, what's going on in the market? What can we expect? What are we seeing and why?
Yeah, so we've had first off, I still think we're in a bear market. We've had a bounce since February 24th. Bounces in bear markets are very, very common. In fact, if you go back to the 2000 to 2003 bear market, we had about 3 bounces there, all the way from a 10% bounce to a 21% bounce before the market overall fell 50-some-odd percent. The 2008 to 2009 bear market, the same thing. We had 2 or 3 bounces of 14 to 28% before the markets ultimately fell to their March 9th closing low of 2009 of S&P intraday low was, I still just kind of think this is amazing.
I know what you're
666 on the S&P, the intraday low. So yeah, I think we're had a bounce. I think the bounce is about over with. There's a lot of indicators that say that we should be rolling over and going. If this truly is a bear market, we should be in what's called a wave C down, which could be a very powerful downtrend. And we'll know for sure if this is a bear market if that downtrend penetrates the February 24th low.
And what was that?
I don't remember the exact number, but that would be a definite break of a pretty substantial support level. But the canary in the coal mine, I told you about this a few months ago. That would be the 10-year Treasury. It has had an amazing move just in the month of March. The 10-year Treasury started the month of March at 1.7%. Mm-hmm. It's now at 2.35. That's huge. Why is that? Because the Fed is starting to increase interest rates.
They haven't technically done it yet, but they're certainly talking about it.
They're going to do it, absolutely. And Powell came out this week and said, in fact, they may increase more and even in higher increments than a quarter of a point. And
we've already seen impacts of that from mortgages, have we not?
Absolutely, we have. So even from a technical standpoint, I think if you look at the fundamentals, the fundamentals are indicating a down economy, which is going to be ultimately end up as a bear market in the stock market.
So I guess listening to everything that you said there, the main takeaway for our listeners out there would be, don't be fooled by this little uptrend that we've seen for the last week. This is probably not something permanent.
It isn't. I would use this bounce to get your accounts set up for a defensive nature. And if you want a second opinion, no better place to come than right here.
And the number that they'd need to call to see us?
336-391-3409.
Very good. All right. So does that wrap up what we wanted to talk about as far as what you've seen going on in the market?
Let's finish up that mailbag.
All right. So dipping back into the mailbag here, we've got Mark in Stokesdale. And Mark in Stokesdale says, Doug and Brice, I feel that I need to reduce the risk in my portfolio.
What a segue, right?
Very good. Mark, it's like you were listening to us. But I don't know where to turn. I've looked at bonds, I've looked at annuities, and I've looked at just moving to cash, but all of those options have drawbacks that I don't like. What am I supposed to do? And I was struck by something that Mark said, that all of those options have drawbacks that I don't like. Well, in reality, Mark, every investment has a drawback that is not appealing. So I usually define an investment in 4 categories that has 4 traits: growth potential, risk potential, liquidity, and fees. Obviously, the ideal investment would have enormous growth potential, would have zero downside risk, would have full liquidity and zero fees. That type of single investment simply doesn't exist out there. So you've got to diversify your portfolio a little bit and try to get those sliders as well balanced as possible. But you are right, Mark. Every investment out there does have drawbacks, and it's a matter of sitting down with a financial planner to figure out what is important to you, what is not important to you. Some people, liquidity is very important to them. Some people, it's not. If liquidity is not that important to you, at least on a portion of your portfolio, that opens up a whole bunch of doors on limiting risk and still keeping growth potential going. Doug?
No, I totally agree. Everything that he mentioned, especially bonds, it is not a perfect investment at this point in time. In fact, if you look at that 10-year Treasury I spoke about a moment ago, that one move from 1.7 to 2.35, that would decrease the value of a 10-year bond by about 20%. Mm-hmm. So, yeah, there's no perfect investments right now, and you can get your portfolio positioned for more defensive maneuvers ahead, but you need to talk to a professional to do that.
And Mark, we don't know how old you are. We don't know how close you are to retirement, whether or not you have a mortgage, what other kind of obligations, liabilities you have. But Doug and I would love to sit down and talk with you and kind of weigh out all of those pros and cons, what's working in your portfolio, what's not, and see if we can come up with some solutions along the lines of what you're looking for. Just give us a call, 336-391-3409. Be happy to sit down with you. We're going to move on next to Doug, another Doug, in Union Cross. And Doug says, Doug and Brice, I don't like my 401k investment options, but my company says I'm not eligible to roll the money to an outside account. I know people who have moved their 401ks in the past. So how is this supposed to work?
Well, I'd say, Doug, we see this a lot too, because you are kind of handcuffed with your 401k options. And if you plan on staying with your company, make it a career, that's what you've got to work with. And, you didn't tell us how old you are, but I think what you're speaking of, what you've seen in the past, is some of your coworkers have used what's called an in-service rollover. But you have to be 59 and a half or older to do that. Most all 401k plans have that feature now. They didn't used to. The Department of Labor, who is the governmental entity that oversees these qualified plans after the 2000 debacle with company-sponsored 401ks, they basically said that to the 401k providers, you should allow your senior employees to diversify. They didn't say shall, they said you should. So that meant that
there's an option.
Yeah, there's an option. So it was adopted rather slowly, but now we see quite a few 401ks. In fact, the majority of the 401k plans have the in-service rollover. So, Doug, if you're not 59 and a half, your hands are tied, or maybe go find another company.
Yeah, that's it's unfortunate, but Doug, leave a note with your HR that you think that they should be giving you that option. All right. Thanks, Doug, for the question. We appreciate that. We're going to move on now to our last question. Claire in Greensboro. Claire says, my husband simply refuses to retire because he says he can't imagine life without a paycheck. But now he's approaching 70, and I really think it's time for him to walk away. What can I do to convince him that he should retire?
Well, Claire, just because he's 70 doesn't mean he needs to retire. One of the things I've really come to understand in being in this business 34 years is people know when it's time to retire. And if he likes what he does and he's still energized when he gets out of bed in the morning to go to work, then, I think that's great. People ask me all the time when I'm going to retire. Well, I'm in that position where I love what I do. And retirement right now is not on my mind. But, if it's a situation where he's scared because he doesn't think that he can go without a paycheck,
right,
then what you need to do is sit down, preferably with us.
Exactly.
And let's see if we can show you how to keep the paycheck but retire the job.
He might be basing his decision on fear and just is afraid that he can't retire. And if we can show him the numbers that he can, that might be half the battle for you, Claire. Another thing for you to perhaps promote to him is the concept of a phased out retirement. This is growing in popularity over the last 20 years as people, instead of just working 40 hours a week one day and then suddenly retired and working 0 hours, let's cut back a day for a year and then cut back another day a year after that. And you get more time with your beloved husband, and he's happier, perhaps, and he's still getting that paycheck. That might be kind of a compromise there. At any rate, I think the best compromise would be for you both to come in and sit down with Doug and myself, and you can do that by giving us a call at 336-391-3409. 888-889-3409. We'd love to sit down with you and anybody else out there. If you're close to retirement and you haven't had a full retirement plan made for you yet, or even if you have and you want a second opinion, 336-391-3409. Doug and I would love to sit down with you and see what help and services we can provide. You can also visit us at thewealthguardians.com. Other than that, Doug, thank you for joining us this week. I hope you have a great rest of your weekend. Garrett, you too. This is Brice Payne. With me is Doug Ray and Garrett Ray. The show is The Wealth Guardians, helping you retire the job and keep the paycheck. And this has been 96.7 FM WTOB.